All right. So welcome everybody to Behavioral Investing, Overcoming Biases for Better Decision Making. We are your hosts, Jay, who's a portfolio manager and partner at Crestwood Advisors and also a behavioral finance enthusiast. And I'm Billy. I have an educational background and credentials in financial psychology, which includes behavioral finance. Jay and I nerd out on this topic all of the time. So when given the opportunity to talk about this, we jumped at the opportunity.
So just a moment for those of you who are joining us who aren't currently clients of Crestwood. So Crestwood Advisors is a wealth management firm focused on helping clients better understand their wealth and achieve their financial goals. We've been blessed to be consistently recognized by Barron's, Forbes, and others as a top wealth manager. We have clients across the U.S. as well as internationally. And as you can see by that alphabet soup of credentials on the right-hand side, we advise clients on a wide variety of different financial planning matters. Investment management, tax management, estate planning, as well as financial psychology, which is what we're going to focus on today.
And so here's the roadmap. And before we dive in, two things. We do have some polls, two of them that'll happen throughout the presentation. So be on the lookout for those. And then second, if you have any questions, feel free to type those into the Q&A and we'll go over them at the end. And so here's the agenda for the day. We're going to talk about understanding and accepting our natural biases. We're going to view a handful of them. There are over 150 of them. We'll cover 6 of them today. Talk about the negative impacts as it relates to financial decision making, and then what to do about it. And so first, understanding our natural biases. First, I want to recognize these aren't necessarily flaws. These are all mental shortcuts that help humans survive in a complicated world long before spreadsheets and markets even existed. And unfortunately, our brains haven't necessarily caught up. Our brains don't get software updates like our devices do. So instincts that once helped us many, many years ago could potentially work against us, especially as it relates to money. And these money experiences or decisions are all based on experience through biology, past wins and losses, fear, familiarity. These all tend to show up, especially during times of market volatility. And so the goal isn't really to fix this or eliminate the bias. It's more to put guardrails around it so that decisions don't derail long-term plans. And so that's the lens for today. We're going to walk through a handful of common biases, as I mentioned, talk about how they influence behavior, not judge them, but think about how to manage them better.
So our first poll question today is, if you could take a moment and answer, how would you rate your driving? Below average, average, or above average? Let's give it about 30 seconds or so for the answers that come in. Very interesting, right? So this is not all that different than a study done by AAA. So AAA asked their members essentially to rank themselves as, again, above average, average, or below average. And what they found is 8 out of 10 members actually ranked themselves above average drivers. And when you stop and think about that for a sec, can the average person, can the majority of people be above average? Well, no, of course not. So this leads us to our first bias, right? And that's overconfidence bias. And we'll have a picture coming up. I love this one. So this little fellow actually believes himself to be much bigger and much mightier than he actually is, which is a really great reflection for how many people think and perceive about their ability to pick things like investments. So how this manifests for investors is essentially typically after a string of recent wins. So if you've, let's say you picked a stock and it went up, or your nephew told you about this hot cryptocurrency and it doubled in a few months. After having a few of these wins, people start to believe that their ability to predict winners, time markets, things like that is actually statistically not just a chance you could do it, but a high probability. All right. And what this leads to is essentially excessive risk-taking behavior, where people don't necessarily realize that they're taking far more risk than they actually do until that hot stock rolls over or that cryptocurrency kind of falls apart. So how do you help correct for that as an investor? So one of the most important things you can do is have an investment policy statement. This is really where you just write out and document what your plan is, what your goal for your investment objective is, like what your time horizon is, if you're going to have a mix of stocks and bonds, and as well as what sort of benchmarks you might have to actually measure your returns. So let's say, for instance, you're going to buy a bunch of large cap US stocks. Having a benchmark like the S&P 500 would help you evaluate over time if you're doing well or poorly relative to that specific asset class. The other thing you can do is actually set up a schedule. So for instance, if you were saying a portfolio is 60-40, 60% stocks, 40% bonds, have a schedule where you reset back to that periodically. So if your portfolio drifts up because the market is doing really well to 70-30, sell some of those stocks when times are good and reset back, right? And likewise, when times are bad, if your portfolio dips too far below that 60-40 because the market is sold off, buy back up to that target again. Having that disciplined, written out plan will help you stay on track.
So next is loss aversion. And what you're seeing on the screen here, two rectangles, one representing loss and one representing a gain. And you can see that the loss is a little bit more than the gain. So that's what loss aversion really is. It's how we're wired. Losses tend to hit about twice as hard as gains feel good, which makes sense. You know, our brains are constantly trying to avoid pain. And you see this real time, especially, you know, if you're watching the news or watching the TV on the markets, down days tend to feel a lot heavier than up days. And that often leads to a couple of different things. First is maybe holding on to losers so that you don't want to admit the pain of a loss and saying like, I messed up, avoiding risk, or even making the much bigger decision that could totally derail your plan, saying I want to go to cash and things like that. And so the reframe isn't necessarily to, you know, not do anything or just put your head in the sand. It's about the plan. And so it's really important to focus on long-term goals and investment horizon, not necessarily day-to-day investment values. And recognize volatility isn't a flaw. It's costing the admission for long-term growth, and learning to tolerate it is just part of successful investing. And so the discomfort doesn't necessarily mean something is broken. It usually just means that you're investing.
Our next one is herd behavior. I love this little illustration, not because I like to see all the fellows in suits walk off a cliff, but simply because it's a really good illustration of the fact that often the pack that you're following, that they necessarily don't know any more than you do as an individual person. So if you think about this, this is a deeply, deeply ingrained human characteristic. And it was a great thing for survival a long time ago. So 10,000 years ago, we're all hunter-gatherers and we're sitting around a campfire and we're all eating some delicious roasted meat. And suddenly most of the tribe gets up and starts running in one direction. Now, if you were still sitting by the fire and you ignored the fact that the tribe had left without you, there's a good chance you would have gotten gobbled up by some predator, right? Because it made sense for you survival-wise to stick with the pack. But that same behavior, that same instinct isn't very helpful to you today as an investor, all right? Oftentimes, following the trend essentially makes you're making a decision that might be right for other people, but not a decision that's necessarily right for you. So what can you do to address this? So the first thing you do is you might stand up and pay attention to where the way the tribe is moving, right? But it doesn't necessarily mean you have to follow them in that same direction. So slow down when something feels emotionally charged, or you see a lot of things moving in one direction. Ask yourself questions like, well, would I still be doing this if nobody else was doing this? And importantly, ask yourself when making financial decisions, is this decision serving my personal financial goals? Tie it always back to yourself and your circumstances, not what's going on with other people.
So I want to jump back in a time machine and picture this. We're doing this presentation. It's the 1970s. You look around and everyone looks like I do in the picture on the screen. You might think, wow, this outfit's really going to never go out of style. But 50 years later, fashion has evolved. And so this is related to recency bias. And this is our brain overweighting what, excuse me, what just happened. So whatever feels most recent, most important, feels most important, even if it's not. That's why strong markets tend to feel like they're going to keep going on forever. And on the other side of it, bear markets might feel like they're going to go on forever too, even when the data says otherwise. And so the fix, again, isn't necessarily ignoring the headlines and sticking your head in the sand. It's putting some context around it. So zooming out, remembering, you know, we're in long-term cycles and trying your best to separate the motion from a trend. And this is really where discipline can matter most. Try to avoid chasing what's worked, what's just worked, or abandoning what's struggled. Long-term plans tend to break when short-term emotions take over.
Confirmation bias is our next one. And confirmation bias essentially is where one has a foregone conclusion, and then they look for evidence that essentially just reinforces that same conclusion. You see this very often with sort of social media bubbles and sort of that echo chamber effect where someone says, I think this stock is a great buy. I think this stock is going to go up. and they will go out and seek out opinions that all say, yep, that stock is a great buy, stock is a great buy, stock is a great buy. But then if they see a report that says the stock is just meh, or the stock is a sell by comparison, then they dismiss those reports unfairly. So how can you correct for that behavior, that tendency to essentially find information that simply reinforces what you already believed? Well, then seek out opposing viewpoints. Ask yourself, based on my investment thesis, what would make this change? What would make me not want to buy it? Things like that. And very importantly, seeking out a second opinion or an objective source, an objective third party can help balance out those opinions.
So this is a great example of anchoring bias. And so, somebody who went to buy a car and thought that 30,000 was too expensive, went back and they saw it was marked down from 60 to $30,000 and thought, what a deal. The funny thing is the car was still worth $30,000 either way. And so this is a great example of anchoring bias. And anchoring is really getting stuck or anchored to an old reference point. And so this could be a purchase price, a prior high or prior low, break-even number, or anything like that. And anchors, like they tend to feel irrational, but what they really are emotional. The number sticks because it protects us from feeling regret, not because it's still relevant. And so this can show up in investing when, I'll wait until X amount of dollars to do this, like retirement, or I'll sell this investment when it gets to X or Y. Even when, the original investment or decision making no longer really makes sense anymore. And so what the better reframe is to do is, decide based on today's facts and your forward-looking goals and plan, not necessarily yesterday's prices or something that you've grabbed onto in the past. And so Jay and I have gone over a handful of these biases. Again, there's over 150 of them. And if you want to Google it online, you'll find a lot of great information out there. But what we'll do here is summarize what we talked about and give a description. And then Jay will go over the investment impact of each and every single one of them. And so first is overconfidence bias, which is overestimating one's knowledge or predictive ability.
So the tendency there is excessive risk taking, sort of thinking, I'm going to pick the next winner. It doesn't matter how big I let this position grow to. I don't need to rebalance my portfolio. That often leads to essentially a negative experience when the trade goes against you.
And then next is loss aversion, where the down day feels a lot worse than an up day, or if something's down, you don't really want to sell it because the admitting that you were wrong could feel pretty bad.
Yeah, and we often see that with investors, where after the market has sold off, they decide that's the time to get more conservative, and they want to sit on the sidelines and wait till the market gets attractive again. The thing to do to how to address this is to sit down objectively and come up with a strategy that you feel like you can hold in good times and bad. And then it'll help you ride out those volatile markets without feeling like you need to actually make major shifts because the market has moved.
The next up is herd behavior. And that's when if you see Jay and I start to run, you come with us.
That's take a moment before you lace up your sneakers and go chasing after Jay and Billy. Look at things objectively and ask yourself, is this decision, is this investment right for me personally in my circumstances?
Then recency bias, which is overemphasizing the most recent news or trends.
Okay. We see this very often with investors who are actually looking at the short-term performance for, let's say, a strategy or a fund, and they'll look at, let's say, year to date or month to date or the last 12 months, and they'll actually ignore a longer term period, say a 3-year or a 5-year performance. So in a short period of time, something can be doing well, but have no predictive value whatsoever for how it's going to do in the long run. So how you correct for this a bit is being aware that time horizons are short and volatility is high when you invest in the stock market. So look at things from a long-term and a more objective perspective.
And then there's confirmation bias, which is I'm right and here's why.
I love this one. And this one is very similar to overconfidence. So how do you kind of tell the difference between these two things? So overconfidence bias is really driven by your ego, your ability to, you think that you're always going to outperform, right? Where confirmation bias is really based on your perception, your eyes and ears. So if this was a game of basketball, your overconfidence bias would say, I'm going to sink every basket, right? And if you're shooting a game of basketball, your confirmation bias would say, every time you hear that swish, yep, I meant to do that. And every time you missed, you'd say, I wasn't really trying to get a basket that time. So how do you help correct for that bias with your behavior as an investor? It's essentially to have an objective set of rules you measure yourself against, a strict policy, and an objective conversation you have with a partner to help make sure you're on track.
Then last but not least is anchoring bias, which is relying too heavily on an initial reference point or data point.
Right, so you see this a few times. One is on infomercials where they'll tell you how much would you pay for something, and then they cross out that price and tell you it's a little bit less, and you think, oh, I've got a deal. Investors, though, see it personally all the time where they have things like a round number anchor. So let's say they buy stock in the 70s and they set in their mind, I'm going to sell the stock when it reaches 100. And the stock goes up and it trades in the 90s for an extended period of time. Rather than walking away with their profit, they will hang on for years in many cases because it hasn't hit that magic number in their head. So they'll be giving up potential growth simply because it hasn't hit their predetermined price target. You also see this a lot when people focus on all-time highs, whether a 52-week high or a high in the market. However, the thing to remember is that over long periods, the market goes continuously up, right? So just as an example, the S&P 500 over the last 10 years has hit 300 new all-time highs. That's amazing. If you had decided to sell out every single time the market hit an all-time high, you would have missed out on tremendous amounts of growth. Oftentimes, one of the best things you could do is stay invested and adjust your price targets to the changing market environment.
And so we're curious to hear from you all. Which of these biases do you think you've experienced in the past? And we'll give it a few minutes for the answers to come in. And curious to see what actually the answers are. Likely getting quite a few answers here. All right. So it's pretty split across the board. A lot of people have felt loss aversion, a good amount of people with herd behavior and recency bias, and then the others with overconfidence, confirmation bias, and anchoring bias. Not surprised, it's kind of evenly split across the board. These are things that happen in everyday life, not just in investing. And as we've said many, many times today, these are all part of being human. Thanks for sharing. Which brings us to the next page, which is how a wealth advisor guides you. And again, before we jump into that, recognize we're all human. Creating some awareness can help. It's not going to fix anything. Jay and I talking about 6 different behavioral biases aren't going to necessarily solve anything, but we hope that the awareness can help. And how a wealth advisor at Crestwood can help you is really bringing in an objective third party that can really help lead to better decision making. And a lot of that is because the best thinking tends to happen out loud. And the research has shown that many times. This is especially true when someone can reflect back what you're saying and try to keep it aligned with your goals. And so that's what really our role is in 3 ways: reducing bias, trying to stay steady during market volatility, and keeping focused on the long term. So helping you avoid bias-driven decision-making. That isn't us saying, hey, Jay, there's your confirmation bias showing again. I would dare anyone to say that to their spouse. It's more so just reflecting back what they're heard and trying to think about exactly what's going on and what their line of thinking is behind the decision-making. Again, market volatility happens. It's just part of the game of investing. And so providing some objectivity during market volatility can be really beneficial. And again, everything we've said today ties it back to the plan. And so when you're investing and planning for the future with different goals in mind, that can really help focus around, how much risk do you need to be taking and how much risk do I want to be taking, and hopefully align, decision-making around that. So what are the key takeaways? Again, we've said this many times, bias is human. It's wired into how we make decisions, especially as it relates to money. While we can't eliminate them or fix it necessarily, we can fix or eliminate potentially the impacts that these decision-making can have. So this is where awareness and discipline can reduce poor decisions. And an advisor can help creating structure. They help create structure and accountability so you can stick to your plan. Now time for some Q&A. So we'll give it a little bit in case anyone wants to drop a question in the Q&A. All right, Jay. Well, here's a good one. Do you have any advice on what I should do next once I've recognized I've made a poor investment decision?
So good question. So first thing I would tell you is don't beat yourself up. This is part of the nature of being human. The thing to do then is if you realize you are on the wrong track, is to seek some independent counsel. So reach out to Crestwood. We'd be happy to talk to folks and help steer you back on track. Generally speaking, all is not lost. So one bad decision doesn't ruin your entire financial plan. The thing is, you want to make a series of good decisions over time and do the things that get you on track. And then once you're on that good track, have a good plan in place to stay there.
Yeah. Jay, I think you're going to love this one. It's well known that active managers underperform passive managers over the long run. What biases are at play here?
Every single one of them. So essentially, asset managers are human, and that is a thing to remember. There are some quantitative strategies which try to exploit biases, which all humans have and tendencies. But this is part of the challenge of being an active manager if someone is trying to beat a benchmark. The reality is you have to decide as an individual investor if your preference is if you want to do the thing that gives you the highest probability of achieving your goal. And is that something that means you need to take additional risk by owning, let's say, individual securities, trying to beat a benchmark? Or can you achieve your goal by staying neutral and let's say own just tracking an index? And that's a decision that makes sense for individual people. So there are many investors who, for instance, can't sleep at night and if they don't understand the individual stocks they own or their strategies. And for those folks, the only way to get them to ride out the thick and the thin and to stay in market cycles in the long term is to own the individual securities. There are many investors who say, holy moly, I don't care if I own Coke or Pepsi, or if I own the S&P 500 or another index. And for those people, they might not have any benefit from owning individual securities or trying to beat the index. So the thing to tell yourself essentially is have that honest conversation with yourself internally and with a trusted partner about what makes sense for you.
Here's a good question. Maybe, Jay, we could both answer this one if you'd like. Is there any advantage of AI in mitigating some biases?
That's a great one. Billy, why don't you go first and we'll give two answers. You give your answer and I'll give one.
Yeah, I think what's interesting about AI is you can even ask it, am I thinking bias? Or what is it? Going back to confirmation bias, you can ask, an AI tool or even, a search function on the internet to look for the alternative to what you're thinking. If you're like, I would really like to do X, you could ask it, well, why wouldn't I want to do X? And then it could list out different things. And here, as it relates to especially confirmation bias, the more that you can sort of read the opposing viewpoints, you can really craft and hone what the argument or thesis is for investing. And so coming back to, advantages of AI and mitigating some biases, it's really using it as a tool to question what your thinking is. And so, yeah, Jay, you want to add to that at all?
Yeah, so absolutely, it's only as just like if you think about if you were trying to build a table, the AI is a tool. It's only as good as the carpenter who uses it. So if you use AI and you ask it questions like, "Why should I buy Nvidia right now?" It's going to give you a biased set of answers. If you say, "Should I buy Nvidia?" or "Does it make sense?" or "Give me pros and cons of things like that," then you're more likely to get a much more objective idea of things. So the best way you can use AI, think of it as an investor, is to help question your thinking. But the challenge will be as individuals, because we all have these biases in terms of how we communicate, is trying to ask objective questions so we're not leading the witness, leading AI to essentially fawn upon us and just give us sort of sycophantic answers, which just agree with whatever we said. So as objective as we can be, AI can be a great partner. However, one of the best things I would advise folks is talking to a bunch of humans, essentially a team, for instance, with different disciplines and different perspectives can actually be really helpful, just as helpful as AI.
Yeah. And that really leads into the next question, which is a really good one. Don't investment advisors have the same biases? And real quickly, and Jay, add to this when I'm done. The short answer is yes. I mean, everyone has biases, and I tend to think about it as a way, you really want to be aware of it and know that when it might be coming up, because you may not even know. And so that was one of the hopes of this presentation, is just to introduce a handful of these and talk about them. And these things have worked in our favor in the past. If we didn't have confirmation bias telling us like, yeah, what we were doing 100,000 years ago makes a lot of sense. Like us as a species may not even be here today. And so these things do tend to work into your favor, but sometimes they don't. And so that's why just creating awareness and using an AI tool, for example, to sort of like question yourself or talking to somebody else, especially a wealth advisor as it relates to investments and personal finance, can really be beneficial over the long run.
Yeah. So yes, we're all human. We're all going to have these biases. As Billy said, they're not all negative. Um, Part of the way you kind of add objectivity is to add a structured process. So I often go back to this, for instance, having a good investment policy statement, having a good conversation upfront, not when times are bad about how what your risk tolerance is, right? But have a conversation when the market is neutral or when you're just starting investing and working with a partner about what would happen if the market went down 10% or my portfolio went up 20%. Would I change my thinking? How would this affect my lifestyle? Having an objective plan and a way to measure, are you on track, tends to increase people's ability to stick with it, right? There's no benefit to having, for instance, a diet that you can't stick to, right? It might sound great, right? But it might not help you be fit and strong. And likewise, you want to have an investment strategy that you can stick to a long period of time.
Any other questions? We'd love to hear them. There is a question around us emailing out slide deck. There is a recording, so we will once we've been able to upload it, can share that around too. All right, Jay, take us on home.
Well, thank you everyone for spending time with us today. If you're already a Crestwood client and you're interested in learning more about this or chatting about these topics further, we encourage you to reach out to your team. If you're not already working with us, we'd obviously be very happy to connect with you and help you develop a sound financial plan that you can stick with in good times and bad. On the screen are a few different ways you can actually connect with us. At the bottom is our phone number, as well as our email address, as well as a QR code if you actually want to scan that in. That'll also have a way to contact us. We really appreciate you guys tuning in today, and we hope you have a terrific day.
Thanks, everybody.
Thank you.